On Friday, the Securities and Exchange Commission, or SEC, said it was temporarily halting the trading of up to 15 companies due to the concerns that their stock prices were artificially inflated. This comes as a reaction to the very turbulent market that we've seen over the past few weeks. In this video, I'll talk about the original catalyst, where the industry is right now, and what the future holds for these traders. Welcome back to Mystery Money. My name's Nick, and on this channel I talk about financial terms and topics that surround money. A company stock called Blue Sphere Corp was recently highlighted in a story in Bloomberg News. The value had spiked following many posts on message boards. The statement from the SEC said, "We proactively monitor for suspicious trading activity on social media and act quickly to stop that trading when appropriate to safeguard the public interest." That statement was said by the active SEC Enforcement Division head, Melissa Hodgman. This is all from the fallout of GameStop's frenzy, in which a Reddit page called Wall Street Bets and other day traders banded together by the thousands to drive the stock price of the company extremely high, from 52-week low of $2.52 to a high of $438. The SEC monitors present values of companies like this and sees it as their job to routinely look out for where such volatility in the markets could potentially cause investors high losses. And if you could do me a favor and monitor that like button by giving it a light tap, I would really appreciate it, as it helps my channel out a ton. There has been an influx of new investors over the past year, and unfortunately with little knowledge of the stock market, they believe these stocks will continue to increase. With articles such as these, it's hard to resist the temptation. Who would not want to get rich and retire with only a small amount invested? This dad made roughly $35,000 at his day job and invested $4,500 into the stock. Shortly after, he cashed out in his Robinhood account a millionaire. But there are also horror stories of people getting in at the peak of the trade only to be left holding essentially worthless stock. With this action, regulators are making even more rules when it comes to these quick rising stocks. Because of the social media pumping these stocks, which are essentially worthless because either they don't have cash flow or they're profitless and therefore hold no real value. What sounds like an investment is simply a way to make quick money. In February, an average of about 90 billion shares changed hand each day on platforms such as Robinhood and Webull. They operate over-the-counter markets, or pink sheets. The December total exceeded $1 trillion for the first time in over 10 years. Most of the times when these pink sheet stocks take off, it's due to some sort of chatter on Twitter or sites such as Wall Street Bets. All of this has picked up speed as most of these Wall Street traders charge zero commission for fees on transactions. Because of this, trading has increased over 20% since last year. 2 weeks ago, the SEC suspended trading for another company called Spectra Science Inc. It had surged over 633% in 2021. This price was artificially inflated due to trading volume surpassing 3.5 billion shares in a single day in late January. Some analysts say that the artificial stock market price is due to the fact that there's extra money being pumped into the market. This could come from various stimulus products. People may not have needed that extra money at the time to pay normal bills, and they're left with extra cash being able to invest. And what better way to put it in the stock market and make a few dollars? We all know that putting some amount of money in savings does nothing and maybe earns 0.01% over an entire year at best. A better option is to pay down debt, but a lot of people are making the assumption that if debt costs me 3 or 4% and I can turn a 50% to 460% profit in the stock market, then that's a no-brainer. But one thing that they take out of the equation is risk. If you utilize that money to pay down debt early, you're guaranteed to make at least 5% on your money. There's always a chance that you could get to the top of some stock, such as GameStop, at $4.50 a share, and now it's trading at $100. For a long time, the stock market has been only accessible to 401ks, retirement accounts, and the occasional person may have extra money to put in. But since the rise of the platforms that charge zero commissions and zero trade fees, such as Robinhood, Webull, and more people are entering the investing. Even large firms have started to reduce commissions, essentially removing the barrier to entry and making the stock market easier to invest. Something similar happened in the 1920s prior to the Great Depression. People were taking extra money and investing it with no real knowledge of how the market worked. They were even borrowing money from the bank to invest into the market to get a better return. Hey, who doesn't want to get rich? During the 1920s, the stock market went through a boom period, reaching its peak in August of 1929. After October 29, 1929, or Black Tuesday, there was some recovery during the next several weeks, but then prices started to drop as the United States slumped into a Great Depression. By 1932, stocks were worth only about 20% of their value the summer of 1929. The stock market crash of 1929 was not the sole cause of the Great Depression, but it did act to accelerate the global economic collapse. By 1933, nearly half of American banks had failed, and unemployment reached approaching 15 million people, or 30% of the workforce. This is a situation that governments have tried to avoid ever since. It is hard to deny that the levels of the stock market continue to break records and not get a feeling like maybe it's at the top. This is the kind of roller coaster where you're always looking down, but you never know when the huge drop's going to come. And unfortunately, no one can predict it. This could be the reason why we are now seeing more intervention by regulators to clamp down on speculative investing. I would like to think that it's the case instead of lobbyists and special interest groups trying to protect large hedge funds and commercial lending institutions, but in my opinion, it may get worse as far as regulation before it gets better. Who can protect us better than ourselves than regulators? Platforms such as Robinhood and Webull may be regulated out of existence. This is so that the masses are safe, no amateur investors get hurt. I hope not. Technology is the great equalizer, and it's made the stock market open to normal people to take part. It all boils down to personal responsibility, and part of that responsibility is learning how the market works. Do that before you invest your first dollar. It also means that you bear responsibility for every dollar that you win or lose. Thank you for taking time to watch this video. I wish you the best in your investment journey, and until next time, have a great day.